Hello, today we are analyzing IDEXX Laboratories, Inc., ticker IDXX. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. This company has a market cap of $40 billion, enterprise value of $40.5 billion. This is operating in the healthcare equipment and supplies industry, so you can see here that they only have about $500 million in net debt on this business. Overall, pretty immaterial on the overall enterprise value. So they develop, manufacture, and distribute products primarily for the companion animal, veterinary, livestock, poultry, dairy, water, testing markets worldwide. It sounds like a pretty good industry. They operate through three segments: companion animal group, water quality products, and livestock, poultry, and dairy. Has point of care veterinarian diagnostic products, so that's a good one. Here we have instruments, consumables. Consumables tend to be a pretty good marketplace. Assay test kits, laboratory diagnostic. So basically all the tools used in the veterinary area. They have also similar products for livestock, poultry, and dairy products. So there'd be a core piece here. They had a test kit for human COVID-19 testing. A few other assay kits, products. They have software and services associated, and so sounds pretty interesting. So return on invested capital, first thing here, it looks extremely high quality in the sense that you have 20 straight years of profitability off the chart. The lowest year of return on invested capital was 22 years ago. In 2000, you had a 13% return on invested capital, and it's basically just increased since then. You exceeded 20% in 2005. And since 2017, you've been above 30%. So 2018 was 34%, 38%, 40, 44, 36%. These are incredible return on invested capital chart numbers. Not only do you have the constant profitability, every year to year is pretty stable. You just see, for the most part, very stable returns. They did accelerate in 2018, so now you're at a much higher level. But you're not seeing a lot of volatility. You don't see cycles in these numbers. It's not cyclical. That's a good sign. So you have profitable, non-cyclical, pretty steady results, and overall trending upward. We can see this is trended upward over time. So you're getting better and better results over time. You really like to see this for a company. Instantly makes me think, hey, high quality business, good results, probably has a strong moat. Really like what I'm seeing in terms of the incremental returns. When we look at the return on invested capital, the 10-year median return is 28.6%. Return on equity is 80%. Just incredible world-class type numbers. Normally, I want 10% plus return on invested capital, 15% return on equity. These are just incredible. You don't need a single bit of debt on this business in order to run absolutely world-class numbers. Once you get over 20% into the 30% plus range, you're talking about absolutely incredible returns. So they can self-fund all of their growth. All these numbers are substantially higher than their revenue growth, asset growth, free cash flow growth. They're not going to need any debt to run this business. It's just operating at a very high level. So very high quality business, very strong growth. 10% revenue growth. They're hitting the 17% EPS growth. Both of these numbers would give me strong confidence that I have clear paths to double-digit returns because I'm able to hit my 10% metric simply on revenue growth, and we can already see that you're getting some operating leverage because the EPS is growing substantially faster than revenue. That's a very good sign. You could have also known that simply that the revenue is growing faster than assets, your return on invested capital getting better over time. All of these things are very positive signals that, hey, high quality business, something I should be paying attention to. Now, the first piece here on valuation is this company is clearly expensive. PE ratio of 50. So I want to first check, is this PE ratio real? Does that really describe an expensive business? And we can check that with the other numbers here. Price to book of 36, price to sales of 11. All these EV-based numbers, very high. So we know, okay, so the price to earnings is not overstating the expense. For instance, price to sales above 10 is simply too high. I'm unwilling to pay a price to sales of 10 plus for any company, let alone a business like this, even if it is high quality, even if it is growing at a strong rate, because that's simply so expensive in order to get the double-digit returns that I'd like to see. So high quality business so far, but it's definitely looking to be overvalued, overpriced. But we're still trending towards this being a watch list company, because the perfect thing about a watch list company is it's a company that you've identified, high quality business, strong growth, and you're just trying to get the right price. So far, it looks like that's where this company is going to end up, and we're just waiting on price. Now, the revenue growth you can see is very strong. 1.3 billion to 3.3 billion, almost tripled over the course of a decade, but not quite. 2.5 to almost triple over the course of a decade. Very strong results there. You can see that the revenue growth is very strong. It's stable. It's growing every single year. It's not like when they boosted up with that COVID test that they started falling back. They're still growing beyond that as well. Very good sign as well. You have your gross profit definitely at the tripling range, 756 million to 2 billion. So you're in that range of tripling your results over the course of a decade. Your operating profit has more than tripled. You've gone from 267 to 900 million. And again, what that's showing you is that operating leverage. Your results are getting better and better as you go down the income statement. You're getting that operating leverage where you go from 10% revenue growth, shifting up towards EPS growth. It wouldn't surprise me if we also see something like buybacks or dividends here because they're going to have excess cash. Anytime your returns on invested capital are so much higher than your growth rates, you know that cash is going to build up on the balance sheet. They're going to have to use that. We don't see a dividend here, so we're going to have to see where's that cash going. I'm going to guess there's been some buybacks, but we'll see if that plays out. Part of the reason I can say that is you can see they went from $1.74 of earnings to $8 in earnings at the end of 2022. So what is that? That's over a 4x in their EPS. So how do you go from just over a 3x in operating profit to over a 4x in earnings per share? That's going to be stock buybacks. Most likely is going to play a role there. Now you're probably going to have a boost in 2017. You do from this talk, changes in the tax code played a part in it, but I think there's other pieces as well. Overall, amazing company so far. If you're learning something, if you like this company, if you're liking the show, hit that like button. Don't forget to subscribe. Ring the bell. So, income statement. And we've already touched on those gross profit margins, but you can clearly see that they're managing to keep their cost of goods sold below the revenue, so they're improving that over time. SG&A, of course, doing a similar thing. You can see when their gross profit almost tripled, they basically only doubled their SG&A from 400 million to 800 million, and that allows them to get even better operating leverage going down to the operating profit line. Now, they also did the same thing with research and development. They kept that in tech, from 90 million to 180 million. So they're doing a really good job at managing their expenses. This is skilled management of their balance sheet. They're maintaining their expenses in a reasonable way. They're not paying out too much money so that they can get a very strong return there. You do see a buildup in debt probably because their interest has gone up, but it's not a significant amount of the overall picture. And again, I want to highlight 2017 and 2018 because this is going to play a role here. You can see that their pre-tax income went up from 381 to 458, but their income tax went down. That can only be because they're dropping in the corporate tax rate, and so that's going to be a driver of that operating leverage. But I was right when we get down to shares diluted. 108 million shares outstanding down to 85 million shares outstanding. You can see that they retired about 20% of their shares outstanding over the course of a decade. That's going to give you an extra 2% per year boost in your EPS growth rate. So when we go back to the overview page, you can see their EPS, 7% higher than the revenue. Some of that's coming from the operating leverage. Some of that's coming from the tax cuts. Some of that's coming from the buybacks. But all of that's going to add up to the revenue only growing at 10%, but your earnings growing at an exceptional 17% rate. Now, of course, this earnings rate is why you're paying such a high price. Anytime you're growing at such a high rate where you 4x in the course of a decade, everyone wants returns like that. High double-digit returns are very attractive. And so you get it from stuff like these. These little components all add up, and that's what you're looking for when you're investing and when you're trying to find a company. Again, everything I'm seeing so far, very exciting, trending towards a watch list company so far. Now, let's look at the balance sheet. PP&E. Now I'm going to compare this PP&E and the inventories to our earnings. So at the beginning of the decade, 140 million, 240 million. So let's just call it 400 million in balance sheet assets there. And we go and we're earning, net income, 188 million. So 40 to 50% results there. Now, if we go to the balance sheet at the end and we say 768 million, 368 million. So we're at, 1 billion, 1.1 billion in terms of your PP&E plus inventories. We go back here and we can see on the operating profit, you're hitting that 100% type returns. So your returns have accelerated on your overall PP&E. It's why we're seeing this uptrending return on invested capital. It's because they're getting better and better results without increasing their assets so quickly over time. Now, you do have to add in some goodwill here, but it's pretty negligible. Overall, they're not taking a lot of assets in order to earn these returns. It's a very strong sign of the positive business taking place there. Your long-term debt is about your PP&E, so it's not really much of a risk there, especially when you think about how much better the returns are on this. Your long-term debt, maybe you're paying 3%, 5%, 8%, but on the PP&E that it's covering, you're earning 50, 60, 80, 90, 100%. That gap there is going to create a lot of value for shareholders. No problem at all with the debt or the amount of debt compared to your overall earnings. Very good there. Now, let's go to the cash flow statement. Depreciation and amortization, I like to check against the PP&E. You can see they are spending more on PP&E in the recent years, and they are spending more than the depreciation each year, which is causing this depreciation to increase over time. It just means that they are reinvesting into the business. They're getting good returns on that investment, so it's great to do it, but they are doing that over time. They're not spending any money on dividends. They are taking on debt pretty regularly, but they had a few years in a row here where they paid it down. The big use of excess capital is definitely stock buybacks. Look at how the stock buybacks actually exceed cash flow from operations in a lot of years. They're dumping all of their excess cash into buybacks. I really like to see that. It's a great use of capital, especially for high quality businesses. So I love how the capital allocation is being applied to this business. I like how they are earning 20 straight years of profits. I like how all of those profits are being earned at high returns on invested capital. Not only is it 10% plus, your 10-year median is 28%. 80% return on equity. Over time, holding a business like this, especially if you get it at a good price, your returns are going to trend towards the returns of the underlying business, which are absolutely incredible. They're also going to tend towards your growth rates, which are also very good. So this is definitely going onto my watch list. I'm very like what I see from IDEXX Laboratories. High quality business. Now, it is overvalued. I don't like paying a PE of 50 for any company. So it's on the watch list so that I can watch it. I can see if I can get a good price. If this company gets to an attractive price, either average or below average being 15 or 20, below average being below that on the PE number, I could get really excited owning a business like this. The extra benefit of doing that is when you own a company that's putting all their excess capital into buybacks, as the stock price drops, as the PE ratio gets less expensive, those buybacks get more powerful. They're going to retire more shares. Your returns are actually going to get higher, both from getting a cheaper price, but also because the buybacks done by the company are going to have a greater effect. Very good setup here from IDEXX Laboratories. So I hope you learned something. Hit that like button. Don't forget to subscribe. Ring the bell so you can get notified when I upload new videos each and every week. And my other watchlist companies are in the playlist up above. If you learned something and you like this QuickFS.net software, my affiliate link is the first link in the description below. I hope you'll use that link to get a free or paid account. This is what I use to analyze companies for the first time. This is the software I use all the time. I don't recommend it otherwise. I hope you'll check it out. I get a commission if you use my link, so please consider that. Thank you for listening, and until next time, stop paying fees and start building wealth.